Welcome to our final session of Intro to Angel Investing, which in thinking through the title, it's not so much intro. We want to make this stuff accessible and, cover some introductory and foundational things, but we're really giving you building blocks and we're touching on more advanced concepts. So I think that title is welcoming to all, but please know that this is not all, introductory content. And today, in terms of what to expect and what we're going to talk about, it's around the check, your portfolio, it's what to expect after you invest. And a lot of our investing members, or all of our members that choose independent investments, ask about these concepts regularly. They say, well, what is dilution? How is it going to impact me? What are the expectations for a possible exit? And so we have a lot to cover. This is recorded. We'll make it accessible, but we welcome if you have feedback, comments throughout. Gloss over this. I know a lot of you joined session 1 and 2, which are also accessible, but I am an angel investor and financial industry professional by background, and I've worked in various operational roles at startup companies. And it's not me running or starting an angel group because I think it's cool. I've done it, and I have a portfolio where I've experienced multiple liquidity events. I've seen the good, the bad, the really good, the ugly, all of it. I'm not saying that my story and what I've seen is everything, but what I'm presenting and what I'm sharing with you isn't something I just read in a textbook, but it's something that I live, breathe, experience, and that our angel group also lives, breathes, and experiences. So in terms of what we're going to cover, we're going to talk a little bit about allocations, including mindset, because I think that's a big one, especially for women and diverse folks. Thoughts on portfolio, how might you want to think about constructing or modifying or, rethinking your portfolio? Expectations, when I invest, what can I expect 2 years, 3 years, 7 years? We'll talk a little bit about that. And then some other concepts like dilution. Costs, if you're a part of an angel group or a syndicate, we'll define all those things. So in terms of allocating, I have up on the slide, what just at a high level, what you want to be thinking about, and we'll talk about these independently, but what's your check size? Mostly I'll say, a lot of times when folks join us, they're writing, smaller checks to start, and then they gain more confidence and then they write bigger checks. But we're going to talk about, why you might want to have a portfolio of 15, 20 investments, what that means. And, maybe you don't want to start with smaller checks if you think through the strategy and, the longer term plans. What is your strategy? We're not going to spend too much time on we're kind of not going to spend time on industry focus, that kind of thing, because we did it in the past, but we're going to gloss over it and mention it again. And in terms of allocating, after you write that first check, do you want to write another one? What are your plans? And then, goals is something you always want to think about, which is whether it's, hey, I want the most diverse portfolio possible, or I really want to fund women's health, just thinking about how do you align what you need, what you want, and how is that representative in your portfolio? So let's talk about check sizing, which I also want to talk about mindset here. The back of the envelope approach that people talk about is 10% of your net worth. And if you're thinking about check sizing, of course, you think about, let me divide that by how many investments do I want or am I planning for? If you have a bigger net worth, maybe it's more than 10%. If you're really excited about this and you just want to allocate and you've thought through it, maybe it's more than 10%. Maybe you don't want to do 10%, right? This is not you're stuck and you have to do this. I'm sharing with you what people talk about. 15 to 20 investments, we'll talk about that later, but that's typically what people are kind of planning for. And by the way, if you're in a job, let me just make up an example that's paying, $250,000 a year, and it's a really stable job, and, this and that, and you're getting these, bonus checks, and you're like, you know what, in 5 years or in 10 years or in 15 years, when I believe I'm fleshing out this portfolio, my net worth's not going to be 2 million. It's going to be, I project out, 3.5 or 4, you might even want to think about, if I'm writing my checks over that time period, I might be thinking about that future number. I'm not saying to over allocate, right? This is risky. It's you can't expect your money back, but thinking through how to allocate, just thoughts. These are not investment recommendations. This is, thoughts for, when you're thinking through this stuff. But it's always a good idea, whether you have a partner or a financial professional. Frankly, I will say a lot of wealth managers and financial advisors, they are not incentivized for you to invest in things like private investing and angel. So frankly, they may tell you not to do it. They may, not giving you advice. Like, they just may not understand it. But what you can have a conversation around, if they're not, understanding of this asset class and what you can do with it, is you can say, hey, if I'm planning to allocate, around 10% of my net worth over the next 15 years, can you come up with a plan so I can feel good about what is that number? So there are things you can talk about, and they should also know what you're doing if you have that dialogue with them. But again, they're not necessarily going to support it. When you're thinking about check size, and you can always start smaller if you're not there in terms of the confidence, or you're not feeling that authority, that's fine. Investing alongside others can be another really great piece to, you're starting out, or you're trying to get your bearings for what's that check size. But I really challenge you to think through your situation. And the other piece of this is the mindset. And a lot of women haven't necessarily grown up with a pat on the back saying, as a girl, you can do this, or, you can be an investor, or you can buy your house. Like, these things that gender, unfortunately, has cooled women into this. You have a certain amount of money and you need to hoard it, or you need to spend it on groceries, not thinking about investing. And so to unpack that and to say, wait, as a woman, I can write these checks, that can be a much bigger journey, but I've seen it happen in our group. It's really exciting. If you have the capital, and if you want to do this, don't be constrained by that hierarchy or what society told you, you can do, and do that mindset work. And, and we can talk to you about it if you have questions, but think through the logic and the data of it. And just because you haven't done it before, just because you wrote smaller checks before, doesn't mean you can't step into more influence and power here. So I just want to make that point, because I know it's one we see often. So talking about money is something that makes a lot of us, or a lot of women, uncomfortable. I mean, this has been seen in, many studies. Just a reminder, if you're not talking about it, you're not talking about deals, investments, these things, you'll miss insight. You won't have as much confidence or feel that authority, right? Because if you're just thinking about it yourself, you're one person. My wealth manager, frankly, has given me advice that I've put out the window. They're like, oh, you should write bigger checks. And I'm like, well, I do this and I do that. And because of that, so forget what I'm saying. I can write bigger checks, but there's a reason I want to allocate to more. That's my personal decision, right? And so just things to think about. And no worries if you don't want to do this, but if you're open to coming on camera, I thought it might be a fun exercise. I'm going to pause the screen share. I thought it might be a fun exercise for us to do a quick image capture, if you're open to giving me, and if more people want to come on video, you don't have to, but how does it make you feel when I say to you, let's talk about money, and I want to capture a picture of that? So again, I know this might sound a little crazy, but I think, again, a lot of times as women, it's like, okay, money, like, what are we talking about here? So just think about starting a conversation about money where this is not something that somebody else brought up. You're just like, hey, let's talk about wealth. Let's talk about wealth building. Let's talk about allocations. How does that make you feel? Give me a face. I'm going to take a screenshot. We may share it on social media. So I'm going to smile because I like to do this, but I also like awkward conversations, and I love women stepping into money. But whatever face you want to give me, you have 3, 2, 1. Pam gave me a little bit more of a scared face. So I appreciate that. Okay, so let's move on. Diversification. If you have a finance background, you hear it all the time. If you don't, basically, the more exposure you can have to different asset classes, different industries, different, world locations, like it's going to basically make your portfolio one that in the long run, based on, data studies, it's like, it's going to do better. And let's just say you have exposure to something really narrowly focused. There could be, I don't know, an issue in that country, or, all of a sudden that sector was overvalued and, now it's plummeting. So diversification kind of can protect and also in the long run help you out. So the first point I want to make is you don't want just a few investments, right? Angel is not only very risky, it's literally an asset class where you have expectations that many positions are not going to work out, which is unique to public markets, right? But in public markets, you can think about spreading in many, many ways. I want to make the point that many private investors may focus in on a few industries. Private markets are different than public markets. I don't think there's anything wrong with, if you did want to have, a pretty tight focus. Again, private markets very different than public markets. Are we going to have the same valuation, inflation, this and that? If you're investing early, you don't have to worry about that stuff, frankly. So it's not a bad idea to, have exposure to a few sectors, but just private markets, I don't think you have to follow all those standard rules of diversification, except you need to make sure there's not just a few eggs in your basket. Company and employee equity, like think about it. If you have it, you probably have a big outsized position, just stuff to think about. It's really nice to spread some of the wealth or, investments across around 15 or 20 or so. And in terms of the expectations for a portfolio, and people ask this one all the time, we're talking 7 to 8 years on average for an exit from, the company launching. So if we invest and it's a year and a half in, subtract that from the 7 or 8. There's possible liquidity events sooner. We're going to talk about that. I already made this point. Expect numerous investments to go to zero. Natalie, why are there horse racing people on the screen? A lot of people talk about, private investing, angel investing, like horse betting. You can have an edge, you can be smart about it, but at the end of the day, it still is gambling. But yes, you can have the edge and you can be a lot smarter when you do it. So I don't want you to be, scared by it. And then, other expectations, expect dilution. We'll talk about what that is, but that basically is your position, meaning there's less ownership when others invest. We'll talk about it. A really important point here, big winners in a private portfolio, if you're an angel, if you're a VC, they're typically carrying the rest, meaning if I have 20 investments, 2 of them or 1 of them may be a massive performer, a few of them might be decent performers, and a bunch of them might be zeros. And that's okay, right? So the big winners, right? Think about that. That's in angel, you can have these really big, outsized returns. And it's really exciting, but it's something to be aware of, right? That not all your businesses are going to work out in angel. So what's dilution? And again, questions welcome. If you have a question, others will have the same question. So please, don't feel like this is just about me speaking if you have questions. So typically, right, you invest at an angel round, which is earlier in that company's cycle, as we've talked about in the other series installations. And there will be funding rounds after you. Even if the company says to you, yep, we're going to be profitable and we're not going to take any more capital, and they tell you all these rosy stories, but frankly, they're almost always, if their venture trajectory, and they're working to grow fast and they're going to have a burn, they're going to keep funding. And it could be about faster expansion. It could be about, winning that market. But expect additional funding rounds. And on average, what happens is you're going to be diluted, or your ownership position is going to decrease by 12% a year. Why do I have a picture of a pie on this page? So Rachel brought up a really good point when she was reviewing this deck, and I want to make sure I explain it well. even though your position or your, piece of the pie is getting smaller, the pie should be getting bigger each funding round, assuming the company is doing well. Meaning you invest and it's $10 million. The next investment round's at $30 million. So even if your piece gets smaller, it's going to be worth more because now the pie is a $30 million pie, not a $10 million pie. And so, concepts to think about, right? Your ownership position's going down, but hopefully the value of it's going up. And that's what happens in a successful business that, keeps fundraising. The bottom of the slide, and people have asked this, well, what if I want to maintain that percentage? All right, well, how much money do you have? Because when they're raising it at 30 million or 50 million or 100 million, like it's really tough as a, non-institutional, non-professional investor to take your own capital and keep that same, percentage, and you don't have to. But the term pro rata, and a lot of times you get these pro rata rights, it's the option or the ability for you to get the look or invest when they do later stages, so that you can basically keep your whatever that ownership position is to get you to, what you started with. So that's what pro rata is. But again, as an angel, I don't think that's something you're probably going to do. But we've talked about it in earlier sessions. If the company is really performing and if you want to put in a little more capital, maybe you want to, right? Your decision, your portfolio. And the best VCs out there are doing the pro rata or, keep investing. All right, so let's move on. Some examples. So the first example of dilution, if you invest 10,000 at a 10 million cap, meaning it's assuming maybe you invested in a safe or a convertible, and basically a $10 million valuation. If there are 5 years until an exit, your exposure is going to roughly halve over the 5 years, assuming that 12% each year. If there's a $300 million exit, and I'm putting in here 4%, $4,000, syndication fees, 18% carry. We'll define what those are later, but just to make this more realistic, you're going to see an 11.6 times return on that invested amount, or $126,000 returned, or back to you on the $10,000 investment. So try to remember that for a second as we go to the next one, which is if there's no dilution, same scenario, right? Same $300 million exit, no dilution, you would have a 22.8x. Okay. Next scenario. If there was a $750 million exit, a 30x, no dilution, a 58x, right? So just showing you, right? Your exposure roughly halved over those 5 years, right? And just giving you, what those numbers might look like. Again, you expect dilution. It's not a bad thing. Other investors joining, good investors, or getting more, money, what might happen if they don't get more capital? They might go into the ground. So dilution or, other investors investing, not a bad thing. But it is good to recognize, what that means in terms of your percentage. Now, what's a liquidity event? We get this one all the time, and there are different types. We're going to talk through them. But at the highest level, right, the definition of a liquidity event is you have the ability to get money back, not necessarily with profits, because the company maybe didn't work out. Sometimes the company works out, and because of the dilution or because of some scenario of you investing at a high valuation, not typically angel, but you're actually, below water. But anyway, it's getting money back, hopefully with profits. A liquidity event can happen before a company exit. The secondary market is basically, let's say another investor is coming in and they say, we want to also buy, we're happy to buy more if some of your early investors will sell us their shares. That happens on what's called the secondary market. There's also liquidity events, of course, at a company exit. I shouldn't say of course, but typically at a company exit. We're going to talk about why it's not always, and it depends on the type of exit. So here we list out, what are some types of investment exits. There could be an acquisition of the company, which is something that oftentimes we're seeing if we're investing in these, angel deals. I know a lot of times we're doing a lot of health tech at She's Independent, and a lot of times there's a really strategic acquirer that's already a partner or already an investor. And so, if they get acquired by a company, we may get, cash. We may get shares in the new company. Oftentimes I'm seeing cash, but I'm just saying there's other scenarios out there. It could be a merger. It could be a recapitalization or restructuring. This could be a little grayer, but a recapitalization, of course, is looking at that cap table and new investors coming in or new money coming in, and everything's out the window. It's it's a negotiation. We're probably not with many rights in that room, if we're even in the room. An IPO is a possibility. Company goes public. That, of course, is an interesting one where there's different rules you have to follow if a company goes public. But of course, ultimately that's cash opportunity. And there's also an investment exit, which is say goodbye to your capital. Unfortunately, it's a write-off or whatever. In terms of your strategy of I wrote a check, and now I need to think through what's next. There's a lot of questions. There's a lot of things that you can do. There's a lot of things that you can say, you know what, not for me. We talked a little bit about that reinvestment piece, which is if the company's working out and if you have the look on an investment, maybe you do want to reinvest. Maybe you started small, right? And you're like, you know what, now I'm writing bigger checks. I wish I had more in that one. If you invest with a group, the group has to typically be the one that reinvests. You can't do it individually, but again, these are all things we can talk about. Think about the valuation. Is your check going to be meaningful? Because if it's a really big valuation, and you're not really increasing your exposure, it may just not be worth it. There are other ways to add value, to your portfolio. Companies may ask you, or you can be proactive around, making introductions, sharing things on social, sharing advice. I one-off have jumped on calls with companies that I'm an investor in. The bottom of this says, but should you, right? And, something to think about is if a company is really kind of not working out and there's a lot of internal issues, you might not want to waste your time. If you can help the company and there's good alignment and they're doing okay, great. Maybe that's a good one to help out. If the company's doing fantastic, they might not need your help. So just be, kind of a little bit intelligent there. Hey, the company that's not working out, you may love the founding team and still jump on calls, but just be aware of, where your time's going, because time, energy, all of that is important and valuable to recognize. So just a quick look at our portfolio and some of what we've seen and some of what we've done. The leaders of, in terms of leaders of where our members have the most interest and where we're investing the most has been health tech, clean tech, and sustainability. And excuse me, I should say health tech and healthcare, not just health tech, meaning there's not always a tech component. So healthcare, health tech, clean tech, and sustainability. We still invest in other sectors, but those ones by far have seen the most interest. On average, we're investing, 75,000, but we've done, we've invested less, we've invested over 100,000. It really depends. Of the 13 syndications, meaning group investments, we'll talk about that later, that we've made, that we've allocated to as a group, only one we've done a follow-on for. We had really good terms, so I'll say that. We're 2 years and a couple months into this investing journey, and we haven't had any exits yet, but we have had a liquidity opportunity, so we could have gotten our cash out on one of the deals at a 2x valuation. And we've had numerous companies that we've invested in raise at higher valuations. So just, again, a little anecdotal advice. Oh, you know what? I should also go back and say, we've made some introductions. We've been influential on some board and executive placements. We've shared things on social media. So we've also done some of the things that we just talked about, right? I'm just giving you a little bit of a glance of the fact that we haven't had exits, but we're, 2 years in. So really exciting, I think, place to be. And I do believe that we'll start seeing, continued increased valuations, and then, at some point, some liquidity and exits. So in terms of what we're seeing in terms of the individual checks, I'm not sharing any individual data, but what I will say is 5,000 is the most common check we're seeing today. We're seeing a lot of checks that are bigger. We accept checks that are 2,500 for a first check. Regularly, we're seeing 10 to 25 and more. But the point I'm making is 5,000, right? We're not requiring it to be, you always have to get them bigger. We're saying what feels good for you. And I think that for a lot of our members, because a lot of them are new to this, they're thinking a little bit about kind of what's the smallest thing I can write, because that's what I'm comfortable with. And that's not a bad thing. But again, the world we live in and what we want to influence, I'm so excited when these women and when, diverse folks say, you know what? I wasn't taught this when I was younger, and I'm learning the thing at whatever age I'm at today, but you can write bigger checks if your financial position allows for it, and it can be really influential and feel really good. We're also seeing, direct checks to businesses often at a $25,000 minimum, but sometimes 50 or 100. Direct check, what does that mean? We're going to talk about that. So we have a slide on that. So let me define what a syndication is, or what an investment vehicle is that we use when we invest. A syndication is an LLC that we create so that we're able to pool capital and invest as one line on the cap table. The founder does not want 20 names and small checks and have to manage all of that. We manage it all when we form this LLC or partnership agreement that basically has a bunch of investors that, sign documents and say, we're investing through this entity, and together we, wire our collective funds to the business. We at She's Independent, when we form a syndication, are also generating those K1s and providing those to the individual investors. So that's our investment vehicle. If we don't invest as a group or as a syndication, members in our group are able to write direct checks. And what is a direct check? A direct check is, we're not forming that vehicle. You're investing directly in the business. You're wiring directly to the business. You're not wiring to She's Independent, where She's Independent wires collective funds. Again, there's likely this higher check minimum. And in this case, if you invest directly, those K1s, and we're going to talk about what K1s are in a little bit, the K1 comes directly from the business, meaning the business is going to give you your tax documentation. If you're writing a direct check, if you're writing a check, you're not a part of an investment group like us, investing, we won't necessarily perform diligence. We won't necessarily, be able to support you. So it's all things I want to make clear, right? Direct check opportunities, they can be great, but they can also be a little scary, and, it can be a little bit more work. Sometimes we do perform diligence. Sometimes we perform diligence because we like the deal, but there's just not enough interest to syndicate. Or, at the end of diligence, we say, based on X, Y, and Z, we actually don't want to invest, but somebody may have all the diligence and say, you know what, I still want to invest. So sometimes there's still diligence. Sometimes when we perform diligence and we say we don't want to invest, it's more of a punt and it's too early, or we want to see X, Y, Z, and we're de-risking. We may not invest later, but we may. Let's talk about fees. Because when you syndicate, or you form a group investment vehicle, or you invest through a group, or through a venture fund, there are fees associated. And we really like to be very transparent on all this, and also really fair and equitable. So in terms of fees, first I want to define, carry or carried interest, because I know this is something that may be new for a lot of folks. Carry or carried interest is basically a percentage of the deal. So 18% is what we charge. Most groups charge 20 or 25%. It basically says, when we invest collectively, on returns, So not, the 1x, but on returns where you're getting something back for your money, 18% of the profits that we're getting back is going to go towards call it the house, or in our case, we share it with members and deal leadership. We'll talk about it. But that's what carried interest is. People also call it carry for shorthand. So for us, we have membership dues, which we're doing a ton of work to curate, the experience we do at She's Independent, whether it's, support and the mentorship, the deal meetings, like all this work. And it's pretty low comparative to, some other groups out there, and seeing, who compares in terms of deals. Our $4,000 syndication fee is half, or I should say even less than half of the industry average. We see $8,000 to $10,000 on average for the industry syndication fees. And there's no management fees. And there should not be management fees for an angel group, ever. If their management fees run, okay? But I'm going to give you some examples of not just what other groups, might charge, but then we're going to talk through some examples of what does this look like in practice. So I mentioned, it's typically 8 to 10 syndication with other groups. And again, some of this may not be transparent. You have to ask sometimes. Absolutely read the fine print, ask the questions. And professional investors are often charging, it's typically 2% of, your assets under management annually. And the reason I'm enunciating that or repeating that is you're like, oh, 2% annually. So it does add up. So they better be good. And carried interest is typically 20%, but a lot, I've seen outperformers, or, when the returns are really high, they're going to take more. The important thing, and I've bolded this at the bottom of the slide, is do they charge more for outperformers? And I'll give you an example, which is I was a part of an angel group before I started one. And I did not like a lot of their operations. And I realized that they were, it was pretty predatory. And I'd already had success angel investing alone. It was more about networking. But they were charging 25 and 30% for outperformers. Let me say that again. They were charging 25 and 30% for outperformers. And their excuse, or the way they positioned it, was, yeah, we're charging less if they don't do well. So if we know that the outperformers on an angel portfolio need to carry the rest, but you're charging the most on outperformers, what does that do? It's not good. If you're not a mathematician, you can think about that, but I'm telling you, it's not good. So I'm going to give you some examples of what does this look like in practice. So investment example 1, invest $10,000 at a 10 million cap, 18% carry, 4,000 syndication fee, no management fees, no dilution, $100 million exit. And by the way, there will be some probably nominal, fee at liquidation, or, ultimately at exit, which I did not include. The investor receives a 7x return, or $80,000. Now, 20% carry, $8,000 syndication fee, no management fee, 75,000, 6.5. So it's not drastically different, but I'm just showing you, right? Like, this was a 20% carry, 8,000 syndication. What if it was a 25% carry and $10,000 syndication? Like, it does add up. And we're going to give you some more examples. So here, 25% carry, 8,000 syndication, 2,000 management, $69,000, or 5.9x return. This is a 2% management fee, assuming it was only taken once, meaning you might have had the money in there and, you're investing over a 5-year horizon, and they're taking 2% of assets each year. I only charge the 2% once. But I could have said, over, this type of time frame, and then that number comes down drastically, the return. So let's talk about carried interest a little bit more. Carried interest is something that we're not the only angel group that does this. I think we're really unique in that we do a ton of education, mentorship, and driving engagement so that members really have a path to, if they want to be a deal leader. But it's not strictly us. If you participate more actively and if you source a deal or help screen or, participate in diligence, you can actually earn some of that carried interest, that 18%. We share that with our members that do these things. If they're accredited and if they invest in the deal. We're actually figuring out a mechanism if folks are not accredited or if they didn't invest in the deal and if they did one of these things and we ultimately invest in the deal. So stay tuned. But it's really interesting because, in this case, here's an example, and it's a business we looked at, and we didn't invest in this one yet, but it's something we looked at. And I'm just giving you an example where Latha, who, hey, guess what? She's on this call. Hi, Latha. She was sourced this deal. The diligence co-leads, we always have them. I don't, this deal didn't get to diligence yet, so I don't have the names. Venture legal actually would be in a woman in our group, Aravinda, who's our venture kind of legal leader, which we're really pleased and thrilled to have her because a lot of groups tap somebody without a venture legal background. So in this case, 15% of the carry would go to members. The reason it's not 20% is that Rachel, who's our deal leader, I believe screened this one. And so it wouldn't go to a third party. But just giving you an example. So that collaborative, collective effort not only allows us to operate in a more interesting, scalable way and, raise up Latha and, anyone who wants to be a leader in the deal. But we end up sharing, some of that upside if we invest and if the deal pays out. So we talked about K1s, skipping a little bit around before. We're going to talk about them a little bit more now. So if the deal pays out, or, after you invest, I shouldn't talk about if it pays out. After you invest, what happens with accounting, right? What do I do with my taxes? And this is a question that, new investors ask all the time. A K1 is basically a document you're going to get after you invest. So if I invest in my, 2023 deals, in 2024, I'm going to get the K1s. And the K1 reports these cash flows and ownership, and it's a partnership agreement. And there's a lot of zeros if it's a startup, that you're investing in. And tax law just changed in the US where you don't actually need one each year now. It's in the beginning, when you kick off the investment and you invest, and then if there's a liquidity event or, material change, maybe there's a change in ownership. But that K1 is what you're going to give your accountant, or, if you do your taxes yourself, you're going to enter it. And that's a part of, reporting and, taxes. Sorry about the plus shorter runway and we still invested. That's from a prior deck, so ignore it. But basically, the K1 is something where, again, if you invest via a syndication with us at She's Independent, we prepare it. If you had invested directly with the business, they're going to prepare it. Really important to keep your information updated so that the K1s are updated, meaning they might be mailing them, so physical address. We're doing it electronically. If your email changes, really important to stay on top of that kind of stuff. What else? How is the company communicating with you outside of K1s? Email communications, or I should say investor updates and communications, that's completely up to the company because private companies don't have to meet those strict guidelines of, reporting earnings quarterly and, giving certain things to, investor relations so that you can, be on top of some of these really detailed reports. Private companies may or may not send emails monthly, quarterly, when they feel like it. I would say, founders that have done it before and founders that know how to raise capital, I mean, they're pretty on top of regular, meaning, monthly or quarterly. Monthly is pretty standard if, they've raised a good amount. Quarterly, is pretty expected if they're maybe newer. But some of the newer, founders, they might not be sending them, unless they're ad hoc. Another thing I'll point out is if they take angel capital, it's different than institutional, meaning, venture or private equity. Investors can also dictate terms, when they invest. Hey, we need monthly or we need quarterly. So we don't do that as angels. We could maybe, but they wouldn't take our money. But at the end of the day, these communications are often including things like, this is what we've been up to. This is the good, this is the bad, maybe the ugly. Here's asks, CTAs, can you share this? We're looking for this hire. This is capital, we're thinking about raising again. You can reinvest if you want. Do you know investors who care about XYZ? So I actually am just sharing in here. It's a small screenshot. You may not see it, but it says Farm Share Investor Update. I'm not even an investor in Farm Share. But because they know I'm an investor and that I had interest at some point, they're sending me those updates. So sometimes they're keeping it strictly to, and it might be a different list of these are the folks that actually invested. Sometimes it's a broader, anybody who they're thinking about maybe, in there for future capital. Okay, we got a note or question in the chat. Can we talk about how to think about investment, market cap valuation and valuation at investment and exit valuation, how they relate? What should we think about or look for, i.e. is a lower market cap better? Also, what are generally good terms? Or what should we look for considering investment terms? So yeah, investment terms, maybe we'll do a member-only session on that one, and we can include Aravinda, even though I'm happy to speak to some of it. But what I will say is, so you say market cap. Did you mean the investment cap? Like the valuation cap? I'm thinking.
Yeah.
Okay.
Yeah.
So if you invest in a convertible or a safe is a form of convertible, lower cap is better, okay? Because at the end of the day, in a safe, we'll typically say it'll convert at this cap or maybe this discount. A cap is phenomenal because a cap, the discount's pretty standard at like 20%. The cap, if you get a cap of, let's say, 20 million and their next raise is at 40 million, and you get to convert at 20 million, that's a much better discount than 20%, right? So typically, typically that investment valuation cap is really a phenomenal one via the safe note. Can we negotiate, as an angel group or as an angel? It's typically harder because our checks are smaller, but sometimes people are open to it. Sometimes it's the cap or the discount. I'd go with the cap if, you have one or the other, but it's tough. You also talked about, valuation, investment, and exit valuation, how they relate. Some of those examples earlier showed you, right? If there's no dilution, you kind of get a sense for, wow, it's kind of the return I was expecting. If there is dilution, it's not going to be the same type of multiple, but it's still, a huge return on your capital.
So I think my question is, like in the examples, most of those exited at around 100 million.
Yeah.
It seems to me it doesn't make sense for an angel investor for something that's going to exit at like 40 million if your investment cap was 20 million, right?
It's a great point. It's a great point, Latha. We do talk about that when we invest, which is a medical device, and they talk about a $40 million exit. We would never invest at 20 million.
Mm-hmm.
So having that ability for the multiple to expand and to see maybe a 25x possibility, maybe it doesn't have to be, a unicorn potential, because sometimes, if you can get it at a 5 or 10 million valuation, get out at, and there's a good chance that it exits at 100, you may still want to do that, even if it's not a 25x. Like, it's up to the individual investor, but you bring up a great point, which is thinking about, what is the potential exit path? And that's why big markets are exciting. But real companies and companies, that have reduced risk are also exciting. So all things to think about when you allocate. Absolutely. Really, really good points. But negotiation around terms, also a good point. And, that I think would be another conversation, because we weren't planning for it today, but it's a really good one. So let's whip through some of these. actually we're basically at the end, but in terms of what's next, and you and your investment journey, Latha, for example, might be thinking about mapping out, what kind of return do I need to invest in a deal? And maybe it's different based on the industry. Med tech, maybe it's different than, or healthcare, maybe it's different than, other sectors. But what's the thing that, you don't understand? What's the thing that you want to do more of? Hopefully this is, creating and, sharing a platform and some insights so that you can dive into these concepts and say, with a little bit more confidence or a little bit more certainty, I want to do that thing, or I don't want to do that. Being thoughtful around allocations and your strategy, it's tough because you can hear about the industry stuff, but you also learn by doing. And the cycle with Angel, it's slow. So what do I mean by that? You could be investing for 15 years and then start getting, some of those data points you were looking for. So I think being a part of and, talking to others that have done it and hearing the real stories and, what's actually happened, not just about the winners, is a part of it, but it's also you learning as you do or as you observe. I think it's connecting with and, making sure that you're talking about this stuff, you're asking. Maybe an angel investor who's been doing it for a while, ask questions, right? Don't be shy. I wouldn't necessarily say how much you're worth, right? But oh, what did that deal return? That is absolutely fine to ask. Absolutely fine to ask. What was your worst deal? These are things that if you don't talk about it, you're not going to get the insight. So I guess we're going to kind of finish today's presentation there. If you're not yet, involved with us, I know I see members on this, but, you can find us at office hours and of course, email us. If you have questions, we have some really good upcoming events. Pitch day next week. Rachel can't wait. All of us can't wait. Because the deal making is, am I allowed to say a lot? Probably the most fun. I love the education, but the deal making is where it all happens. So yeah, that's what we had prepared. I will stop the screen share. And if you had any more questions, I know we had a little bit of a quiet group, but we welcome it if you want to chime in or, say hello. Or just say thanks, and I'm going to go take a bunch of notes and, find a bunch of deals and build up my portfolio. Is anyone thinking about bigger checks? I mean, maybe you're not investing yet, feel free to share feedback.
One thing I wanted to add real quick was the investor updates that come in. They often come into one person at She's Independent, and so we'll disperse them to the people who had invested in that particular deal over their Slack channel.
But we also offer that if individuals want those directly, which we encourage, we're happy to add them or have them added to the investor comms as well. But that's a great point, Rachel, which is we have Slack for our member community where we have deal channels or, Slack channels where if we did invest, we can talk about deals. If we're thinking about investing, we're diligence, we can talk about the deals. So it's a nice collaborative place where we can share some things, whether it's investor updates or whether it's like, hey, did you see this? I'm pretty scared or I'm pretty excited. It's a nice group of us. And even folks that did not invest in the deal can still follow along if they'd like. It's a great point. All right, so I think with that, maybe I'll stop the recording. Thank you so much for joining.